Okay, good morning, guys. Today specifying on its just pure structure, pure understanding of the markets, and still on what we did before. If you check the YouTube video, we talked about the last class we had. We talked about key entries for high probability trades. So now it's probably the same thing but more advanced. So now let's just decode and reflect on the last session we had. So the last session we had was based on breaker and mitigation block and what's not, other blocks and fair value gaps. So now today I'll be specifically specifying on those same contents again, but in a more clearer and more understanding way, high probabilities trades that you're meant to understand how to take. So the concept of a breaker, I will just draw it again, is that price buying. This is a buy. It takes out this high, yeah, and then come on. Let me give you a more proper outlook. So this is the concept. This is price. It sweeps the low, and then aggressively it takes out a high, and then it fails to touch this particular high, which is going to be seen as the other block that sells to take out this particular low. So now that other block now has been broken without reacting. Any little retracement that you see at this point is going to be seen as an inducement. So therefore, there is your inducement, and then your point of interest is going to be that particular breaker. So I'll just draw it down here. You can get more understanding on what the breaker is talking about. So what I can see here is what a sweep. This is a shift, a sweep instruction. That's a stop hunt, and then price leaves that particular breaker here. This is the breaker. So that is your what point of interest. That is your high probability point of interest. Now, what makes it a point of interest is that there is an inducement, there is a failure. There is a failure push to the downside that fails to touch that point of interest. So this point is going to be seen as unidentified traders that are trying to what? They're trying to meet that point of interest, but they fail to touch that point of interest. So they're going to be seen as liquidity. It's just like saying, I'm sending you a message whereby the order is here, and then other people now go close to that particular point, but they fail to hit that point of interest that sending you that message. Yes. So those people that went there, they are going to be seen as unidentified people. We didn't recognize them coming to our point of interest. So since we didn't recognize them coming to our point of interest, they're going to be seen as what? Unidentified traders, unidentified people. Now, the identified people are the people that actually meet our point of interest, which is what going to be these people here. So that's liquidity. It's a form of markets, market structure that tells you that there are traders that have not met this point of interest. Now, those traders are going to be what liquidated because they tried selling down to this point to be able to buy up, but they failed to. So these people that are buying from here, they have their stop loss sitting below here. Now that stop loss is going to be seen as money because if you are buying from here, obviously, you put your stop loss here. And then if your stop loss is there now, it's going to be seen as other people now that decided to buy from here, their stop loss is there. So let's round it up to like there are 100 people there, and each of those 100 people there put $100 as their stop loss. That's like $100,000. So $100,000 worth of liquid is sitting below those people's stop loss. Now, the point of interest initially is the breaker. So that is what is going to drive price downwards to be able to what? Touch that particular breaker and then push to the upside. That is just pure understanding of pure price action. So that is it for the breaker. Now, the difference from that breaker is the difference from the breaker and the mitigation block is quite simple. You understand that the mitigation block comes like this. It fails to give you that sweep of low. Rather, it's what? It shifts the market structure. Once it shifts the market structure, goes up, it gives you that idea again, fails to touch there, comes back up, and then later on, it comes there, then continues moving to the upside. I need my mouse. Yeah. So that's what brings about this particular point of interest. Can you see that? So this point of interest now that we are seeing, it's a high probability trading factor of points of interest. Now, let's go into the market and see these points of interest and see what we can make out of them what we can envision out of them, what we can use to see if we can have a high probability trading setup. Now, this is currently on BTC, like 3 days ago, and then I can see a little sweep below the slope. Yeah, it takes out the slow. Now, after taking out that low, where's the high? This is the highest point of that low. I'm drawing it out in time. Why? Because it sweeps this particular low, and then price aggressively comes here, it fails, it comes, then aggressively what? It breaks that high. So this high is going to be seen as a breaker because it's meant to be a bearish order block that is meant to what? Continue price to the downside. It's meant to continue price to the downside to form another low. But if that high is broken without reacting, what does it mean? It means that that point now is going to be a point of interest as a breaker because it's broken. It's not useful anymore. So that other block is going to be seen as devoured. So what I'm going to do is that I'm going to take my time to notify this high. And then I'm looking for any failure retracement that tries to come into this high and then fails to hit that particular point of interest. That is where I'm going to have a sense of probability that this is quite high probability. Why? Because they are liquid body, liquid people, liquidated people that are still in the market that try to come to this point, but they fail. So that failure swing, that failure push to that downside is going to be seen as what? Liquidity in the market. So that's what I'm going to look out for. So going onwards, I can see this whole retracement here that fails to touch this high. So this point is going to be seen as what for me? A liquidity. Is that not so? So if that is my liquidity point, I'm expecting price to come and grab the liquidity and hit this particular high before any continuous push to the upside. It's just that simple, yeah? So once I go back in time, and then I have here as my point of interest. This is where you have your entry. You're confident enough. Why? Because there is a failure swing that tells you that these people now that decided to buy from here, they have their stop loss below here. Do you understand? Their stop loss is just sitting below here. So those people now, as their stop loss is sitting below here, what are they going to see the market at? They're going to know that they are going to be what? Liquidated cash, because 100,000 people staying here that are losing $100 is up to like $100,000 or $1,000,000 if I'm not mistaken. So there is a liquid cash of $1,000,000 for the smart money people to come and grab at that point of interest. Once they grab it, they come to the point of interest, which is that breaker, and then they continue that buy move. That is what is causing this whole buy on BTC. So if you're a trader and then you're looking forward to be able to understand the market potentially by your skills and preference in understanding the pure price action of the market, you need to work with the breaker and also work with the mitigation block. And also, we also have the other block. So with that being said, I'll move further and pitch you guys and on looking out for the other blocks, the breakers, and then the mitigation block. So let's take a stroll on the previous chart and see what we can find. So very good. Another criteria is understanding the bullish order block. Now, I'm making it very brief understanding and short. Now, I like to use layman understanding to be able to pass out knowledge to people that are willing to understand the market, not just from a fundamental or technical part, but from a real life tactics, because Forex is a market. It's just like going to an actual market to buy something. So let's say I buy a particular goods. What's happening? Let's say I buy a particular goods from here. Yes, then someone comes and then that person now, yes, buys a particular good too from here. Yes. And then me now, all of a sudden, I have more power, more liquid, more cash. And then I'm able to start selling a good from here. And I'm able to sell out more than the people that bought this goods. I'm able to sell out to take out their current markets, meaning I'm now more profitable and now more of reach to those people. So if I'm able to sell out and break those people's market barrier, wherever their profit margin is, I've told the market now that the structure of the market now has been broken. Because why? Those people were on the winning side before, but now I'm on the winning side. Why? Because I have more orders, I have more, I have more products to dish out. So if I'm able to take out those people's low at this point in time, and then price retraces up, yeah, It's telling me that this particular low, sorry, it's telling me that this particular recent low that I took out and the other previous low that I took out is trying to tell me that there is more selling pressure than buying pressure in the market. Why? Because me as a seller, I have come with my own order and then I've broken the barrier of the buyers in the market. So now there is more selling pressure in the market. Do you understand? So that makes you understand that this particular product now that was here has no pressure, meaning the buyers now they have no control over the market. Why? Because the sellers have taken out their position. Because normally in life, overtaking is allowed. Do you understand? Someone can be selling in one place for years, and then me, I come with my grace and whatnot, and I'm now selling more than that person in the next 2 months. Overtaking is allowed because why? I have more liquid, I have more, financial literacy, I have more, it could just be anything. I have more sense, I have more market strategy. That is just how life is. So basically, this particular buys from here to here is going to be seen as an impulse buy. Now, the impulse buy has been happening for quite a time because price is bullish at that point in time. Because I'm not going to draw the whole bullishness, but the whole idea is that price is coming from wherever, and then it's bullish because price is going up, down, up, down, up. Then now there's a push to the downside aggressively, making it leave what these candlesticks that are going up are going to be seen as green candlesticks. So these green candlesticks now are going to be seen as what? Bullish candlestick. Now, the last bullish candlestick before price sells down to take out a particular recent low and a previous low. The layman language is just saying that, okay, yes, this is Dangote Refinery. I have sold from Dangote Refinery, I've sold a lot of products, and then I have a particular order in my hand. So I'm sending orders out from this particular last bullish candlestick down to this point. So what does it mean now? It means that if, let me say, Otedola Refinery is this buys, and then Dangote Refinery is the sell, it means that the last time Otedola had a capital over me is this particular leg. Why? Because my products are able to sell more than Otedola's product. So now it's no more Otedola's market, it's what Dangote's market. So it's no more the buyer's market, it's the seller's market. Why? Because the sellers are able to have more power to sell than buying. Do you understand? So the concept behind that is that this particular last buy candle, meaning the last product or $10 sold now, I have bought that particular area. Do you get? So now I'm in control of that market. So if $10 people come and then they say they want to continue buying up, they can't buy above this point. Why? Because me now, that is Dangote Refinery, I've already what? I've capitalized on this point and I have more capital than the buyers in this case. So that order, the only order that can take place here is what? Sell orders, which is the Dangote Refinery. So it's just like me buying a portion of land now. Yeah, this land now is now my own. I bought it from Kingsley. Now this land is now my own. So Kingsley's people now cannot go to my land to go and collect any other thing except my people. So it's my people that can come there to collect any order. Do you understand? So that's just the concept of the market. Now this particular area now is now my own. So I'm expecting what sellers to continue selling from here to show that yes, since there is more capital on my own side, which is the seller side, then there should be more push to the market downwards to continue pushing down. So that is just the concept of the bullish or the bearish order block. Now this is in a bearish format. Now let's go into the chart and make everything more fun by seeing exactly what the market is doing. Any pair, you are using this on any pair, whether you are trading futures, you are trading indices, you are trading crypto. If you just understand all these concepts, you can understand exactly what the market is doing, that is pushing up and pushing down. So let's go into the market and see what we can find. Okay, I would love to use, let me use another pair. This is enough of BEC right now. Let me use gold. I'm sure people like gold. Okay, so gold, 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 our brother gold. So initially, what gold is doing here, it's selling, it's aggressive. It's an aggressive sell. You can see that it is an aggressive sell. So on knowing that this is an aggressive sell, you need to find that particular formation that I just showed you. That price what is buying initially, then it now wants to change to sell. Then the sellers are able to go below the recent side where the buyers started buying from, and also able to go below the previous side where the buyers what started buying from. That is just the concept. That's what you're going to be looking out for as you're in this market. So where the price even start from, where the price start from in that momentum. Let's look for something similar, something like that. Okay, I think I'll use here, and I'll make it more wish. Okay, so see, this is price already selling initially. So you need to see orders. You need to see those particular orders that are going to continue to push price to continue selling. Now, I say where you see price takes out a particular recent low and previous low. Now, look at this market. There's a push up, there's a push down, there's a retracement up, and then there's a retracement down. That takes out this particular recent low and also goes down below the previous low. So on me seeing this now, what do I see? I see that there's a pressure selling below this recent low, and there is a pressure selling below this previous low. Now, what does that make me feel? It makes me feel and understand that the last buy candle in this particular market that's able to push down below this recent and previous low, it makes me understand that there's selling pressure. So now, where is that selling pressure? Is the last buy candle. Why? Because those were the last people that we saw in the market before the sellers were able to take over that market. So where's the last buy candle in that scene? This is the last buy candle. So I mark it out in time. And I want that if price comes to this buy candle, I want to see sell. But if price fails to come to this buy candle and then it starts going down, I understand that that point is a liquidity point. Why? Because there's a failure on reaching the point of interest. That failure on reaching that point of interest is what I'm looking for to know that I have a high probability trade. Because if people are trying to sell from here, and that is where price is meant to sell from, do or die, and then they come close to that point, but they fail to sell from that point, it's going to be seen as unidentified. Like, what are you doing? This is not where you're meant to sell from, rather than here. Do you get me? So those particular traders that fail to come to this point of interest, to sell the market to the downside, they are going to be seen as liquid cash because they are selling here and they're obviously putting their stop loss above here. So that's the concept. This point now is going to be my liquidity, it's going to be my inducement. Do you understand me? So this liquidity now is what I'm going to mark out in time. I'm waiting for price to come, grab this liquidity and touch my point of interest before any continuous sell. So now let's look at how price performs. This happens in the next couple of days. And then what do you see? All these points now that retraces, all these points that retrace, come down. It goes up, come down, it goes up. Notice it hasn't touched that last buy candle. So all these points are seen as what? Liquidity. Now, what does price finally do? It comes, it grabs that high. Can you see how it grabs the high? Immediately, it touches that particular last sell candle, last buy candle. What does it do? It starts rejecting. Now, you on your entry confirmation, now this is the 15 minutes. I always tell my students that if you want to enter a very good trade on the 15 minutes, yeah, you need to prioritize understanding the candlesticks. It's just like seeing a green candle, one green candle, and then on your point of interest, you want to sell, and then one green candle has touched your point of interest. The next candle that forms after is a red candle, giving you the momentum that, yes, I want to sell. I'm going for a selling position. Now you have to see two of those red candles in your 15 minutes to confirm that there's pressure of selling the market. Then once you see that too, you enter on the third candle. That's just a confirmation entry. But if you're an aggressive trader and you believe and you understand that this is liquidity and this is my point of interest, first thing first, what I do is that I want to sell at that point of interest for my first entry. And I'm risking just a little bit of my capital by what? Putting my stop loss just at the high of that particular order. And then I take profits, the lowest point. Where's the lowest point here? This is the lowest point. So until price gets there, I'm not out of this trade until price gets there. So you can see how beautiful it looks and how precise your entry has to be by understanding that particular order block. Do you get the idea now? I understand the particular order block. So that is it for the order block, and the breaker also where you talked about it. So now let's pitch in to understand one very key interesting fact that people really they're not forced down. So we understand the order block. This is for the bearish order block. I'm sure that you want to see an example for the bullish order block. So let me just run around and find a very good example for a bullish order block then before we go into the fair value gap. Okay, I think I found one today. There was one I had yesterday. Let me go to the current market points of interest. So this whole highs, this whole push up, it's a very good point of interest as analyzed. So around here is price buying, it's selling originally. There's a huge sales structure originally. And all of a sudden, price stops here, it buys, and then it comes down here, and then it continues going up. Now, I've told you guys about understanding the difference between the mitigation block and then the breaker block. Now, in this kind of criteria, what do you see? I'm sure you can see the mitigation block because there is a shift. But had it was meant to be a breaker block, you see this leg go below here before continuous pushing up. Do you understand? But now that leg doesn't happen. There's a shift in market structure, and then there's a break in market structure above. So now, once that break in market structure above is active, what do you see? You tell yourself that the high of this point is going to be my mitigation block. But on me seeing this mitigation block, I need to see a retracement that fails to touch that mitigation block to give me the idea of liquidity, to know that there are traders that are unidentified there, that price is going to grab their money and continue pushing to the upside. So that liquidity in that form is going to be seen as this push down. Can you see how price pushes down? But it fails to touch this point. Now, I tell people in trading, people that are gambling in trading, I tell them that this thing is quite a precision kind of thing. It's not like sporty bets that you just have to, hope that the team wins, yeah, or they have to score a particular kind of goal. It's not precise at some certain extent. You just have to be precise that understanding that okay, this football team is better than this football team, but anything can happen in that match. Do you get me? But trading is more precise by understanding that this move, yes, that fails to touch this high, it shows me that this is my point of interest. And it shows me that this particular move that fails to touch this high is going to be seen as a liquidity. Why? Because they are unidentified traders that are not meeting to the point of interest. Now, in this concept now, I tell my students that everything that happens in the market, every candlestick that stops at a particular point happens for a reason. The $100, $100,000, $1 million cannot move a 1 second candlestick. So you have to understand you are trading with the world's smartest people and the world's richest people. These are people that put billions, 50 billions of dollars to just move a second candlestick. So imagine how many people is trading in the world. There's $9.9 trillion in the market every day. Every day when you enter the market, there's a $9.9 trillion sitting there for everyone to liquidate off for. So now your criteria, your idea is to come and then find a particular entry, understand what the market is doing, understand the liquidity points, understand the points of interest to be able to take a very good trade. So at this point, I can see a retracement that fails to what? Hit this high. Telling me that this high is a mitigation block, but there is a retracement that fails to hit this high. Bam. That is my high probability trading setup. Now, what am I going to be looking out for? I'm going to be patient for price to be able to come down and hit this high before I take any buy. Now, once price hits this high, I've already taken my buy at the high. I'm good. That is the first confirmation I need. Do you get me? But if that's the first confirmation I need to be able to trade this high, for you to be able to continue to understand that the market is still bullish, the market is still going to go up, you need to understand other factors that have to do with your fundamental analysis, which has to do with this is your mitigation block now. Which other confluence do we have? We have order block, we have fair value gap, we have, breaker blocks. Now, if this point has reached and then you are not an aggressive trader and then you didn't take it from here, you wanted to wait for confirmation. You've seen your confirmation at this particular green candlestick that bought up. Is that not so? Now, what do you need to understand to be able to confirm that yes, this trade is actually going to go up. Now, I would like to go down to the lower time frame to see more, precise entry and more precise confirmation in trading this particular pair. So here is my entry. Yeah, this is where I enter my trade from. I've already entered my trade from here, and the price is moving up. And then I see a criteria like this. Do you see any of your points of interest? Do you see any, criteria? I'm sure you can see this push up. You can see this push down. You can see this push up. You can see this push down. And then aggressively, you can see price taking out the recent high and the previous high. Now, there's something about a double break of structure that people fail to understand. It's not just about breaking structure. Like price cannot just come here straight up and break structure to the upside. It won't give me an idea of a strong probability trade. I need to see price breaking a particular high and also breaking the other high. Why? Because it's going to tell me that my competitor now, the person that let me say this is a sell trade, yeah, it's selling, It's trying to tell me that me now as I'm buying, I have two competitors to go above to make sure that yes, the buy is strong. Now it has gone above the first high, which is here, showing me that yes, the buyers are active because it's taking out the recent side where the seller sold from. And then the previous side where the seller sold from, let me say this recent side could be $100 million. And then this previous side could be another $200 million. So for price to be able to take out that recent side and previous side, it's trying to tell you that the momentum of buying the market is heavy. Do you understand? That's why we mostly use double break of structure for a high probability order block. Now, in that case, you have a double break of structure around here. So once that double break of structure is notified now, you have to understand that you need to look for your liquidity. You need to look for push downs that fails to hit what? That particular point of interest. Do you get me? So your point of interest is what? The last sell candle. Because the last sell candle before price takes out a recent high and previous high is seen as a what? Bullish order block. But the last buy candle that takes out a particular recent low and previous low is seen as a what? Bearish order block. So it's that simple. So understanding that concept now, you are looking towards whatsoever you have to do in the market. Now, let's go down. Let me remove this to make it more clear. And you can see this is your last sell candle. It's a sell candle, it's a bearish candle. Now, do I see any retracements that tries to hit this candle? Yes. All these are retracement. Even this is a retracement. This is a push, then it retraces up. Now, this is an inducement because it's close to that particular candle, but it fails. So this is a very high probability trading strategy for me. If I see something like this, I'm entering with my full mind and confidence that, okay, I see something relating to what I know and what I'm confident in and what I believe in. Because why? There is a double break of structure and then there is price trying to get there but retracing away from it. Going to be seen as what? Inducement. Now, price sweeps that inducement, touches your points of interest, and then aggressively it starts going up. Can you see how beautiful that is? So this is you understanding what? The bullish order block. And then we also talked about the bearish order block. So you can see the difference between the bullish order block and the bearish order block. Note, for a high probability bullish order block and bearish order block, you have to see price take out double highs. There has to be a double break of structure. And if there's a double break of structure, you also have to see your liquidity. So you just have to prioritize understanding few things. Yeah, you need to see your double break of structure. I'll just put it double break of structure, and then once you have your double break of structure, you're meant to see your liquidity. And once you see your liquidity, your points of interest. Your points of interest has to do with your order block, breaker block, mitigation block. So with this out, this is what you are going to to be able to look out for you to understand your what? Your point of interest, high probability trading strategies. You get me? You have your double break of structure, then liquidity is the failure to hit that particular point of interest, which has to be with your order block or your breaker block or your mitigation block. Now, I would have added fair value gap into this criteria for you to understand that there's an idea of fair value gap, but I'll leave that for part 3 of this particular, mentorship course. I'll leave that for the part 3 because fair value gap is on its own. It's not as, it's not so familiar with, this particular setup. There has to be a, formation, there has to be a pattern to understand the fair value gap. And then you can use fair value gap also to confirm your order block, your breaker, and the mitigation block. So that's going to be a different topic on its own. But for now, understand the concept of the double break of structure, liquidity, points of interest, which is your OB, breaker block, or mitigation block. Now you can see how beautiful it looks on the chart. Now taking a trade from here now and holding it overnight till today, that's a whole lot of pips on gold. If I'm going to calculate, that's like, oh boy. That's another 2,000 pips just overnight. You know what 2,000 pips is? As you're using 0.01, you're making up to $200. That's the lowest lot size, and you're just risking, let me say, $20 or $30. That's something worth taking. So, yeah. So with this point of mind, I hope you're able to understand the concepts behind trading this particular, liquidity, double break of structure, and POI. You can see that right here, this mitigation block did a double break of structure. It broke this high, and then it also broke this high. Can you see? So there's a double break of structure there, confirming what this particular point to be active. So always understand those points of interest and always look forward to, taking active trades. Do not fear your position sizing. All you just have to work with is your risk management and let the trade breathe. That all. Don't fear the fact that it's gold, because I feel most people are afraid to trade gold if they feel like they have low capital, because they are like, okay, it's so volatile. It doesn't matter if you have a great sense of humor and understanding of what the market exactly is going to do. You don't have to fear trading gold. Do you get me? Because gold is an asset that is going to give you consistent returns. Gold and BTC, those are very volatile pairs, but trust me, they are very active market because everyone is either buying gold one way or the other. Everyone is either looking for BTC, selling BTC one way or the other. So GBP USD, Euro USD, they are good pairs also. Those are just bank, trading ideas. They're also good pairs also. But for high probability, setups and trade ideas, I prefer using gold or BTC. So for GU, I had a very good trade on GU last week. And it was still the same setup. It was still the same analysis. It was still the same criteria. Now, let me just give you a little pitch on it, why I took that trade. Now, initially, price is here. And then I have a sweep. Can you see the sweep? This is a sweep. It sweeps that low. Then aggressively, it takes outwards. There's a recent high you're looking out for. Where is that recent high? This is the recent high of that particular sweep. Is that not so? And then where's the previous high? There's a previous high here. So there's a double break of structure. So if there's a double break of structure, you need to see price get close to the point of interest. Now, where's the point of interest? You're looking at the last sell candle. This is 15 minutes here. You're looking at the last sell candle. This is your last sell candle because this is the last sell candle you see. Just draw this thing above there. You can see that's the last sell candle. So any retracement that fails to come to this last sell candle is going to be seen as your liquidity. Am I right? So you can see all sort of retracement here. This is a retracement that fails, it goes back up. So this is a very good inducement. And then once price notices that as an inducement, and they notice that the point of interest is still down here, what do you see? Price comes exactly to that point of interest, and then boom, it fires up. It doesn't even waste time. I was even surprised on this trade because it went in like 5 minutes, 15 minutes, I saw my profit. Normally, because this is a news trade, but on a normal scale, when there is no news trade, it could take you let me 3 to 4 hours to be able to see that profit. But it happened under 15 minutes. Why? Because that's a very good point of interest. And then there's a news following it. Maybe Joe Biden just came out to say something, or Donald Trump just came out to say something, and then it pumps the GBP/USD to the upside. So that's just the idea of this particular trade. It's just the same thing we thought about. It's the same order block, which is what the double break of structure. It takes out this high, take out the second high, and then what's inducement, liquidity, and points of interest, and then boom. Simple idea. You don't have to force yourself in being afraid or being, skeptical of what. Now, let me just give you another, cheat code. It's not every day you trade. Because I see when people come into the market, they want to trade today, want to trade tomorrow to test their strategy. You can come on a Friday and you might not see that formation you're looking for, and then you'll be forcing trades. Do you get me? You're going to be forcing like, okay, let me just trade here. It looks like I want to sell, let me just sell. No, it doesn't look like that. You have to understand the fractals of the market, the back ends of the market. What has the market been doing for the past 2, 3, 4 days? Do you get me? Before you can know what to do in the next 2, 3, 4 days either. Do you get me? So you cannot come like, if say you want to trade and then this is what date is this? Okay, let's say this is on a Wednesday. You come to the market on a Wednesday, you don't see any criteria for you to trade. You leave it. You come on a Thursday, you don't see any criteria for you to trade, but you're trying to force the market. You then come on a Friday, no criteria for you to trade. There's nothing to trade, there's no structure yet. Do you understand? You need to see the structure you're looking for to give you that precise entry. Now, on Wednesday, Thursday, Friday, it took Wednesday, Thursday, Friday to form this structure that gave us this huge move. Now, if you were looking for a trade within Wednesday, Thursday, Friday, you won't get this move. You'll be rather expecting price come here, lose money. Price come here, you don't lose your first money, feeling that price wants to continue going down. Price come here on Friday, you say, okay, price come here, you don't miss another trade. So that kind of energy is what's, that sharp money energy is what's trying to, push traders down. You need to be very comfortable to be able to, fuck with the market. So with that understanding, I hope you can, testify to understanding that this particular set of these particular trade ideas I've given you, you can consistently use them over time and do not trade every day. Just come to the market and be able to target what you're looking for, understand the points of interest, understand your liquidity, and then you are good to go. So I'll see you guys in the next session. This is the part 2 of the high probability trade. I'll see you guys in the next session. For those that want to reach out to me, I'll drop my IG and my number here. Okay. So that's my number. If you want to reach out to me on WhatsApp for more mentorship, and then on IG. So see you guys in the next session on Danish Trade, and do not forget to be disciplined while trading. Do not forget to look out for the best. Do not forget to be able to be patient and wait for that particular moment. It only takes time, but you reach there eventually. Peace out. Let me